Hello, everyone. Welcome back to our third part of our discussion of Chapter 6. Here we're talking about expenses incurred in the operation of a business. So we've already satisfied the idea that the expense we're talking about is necessary for the business. But there are some things, some special, you might say, expenses, ones that get particular, have additional rules that because they easily be abused, you might say, as at least from the IRS standpoint. So first of all is transportation and travel, and the difference is travel, okay, is away from tax home, and there's lots of issues about what your tax home is. We'll try to keep it relatively simple. That requires an overnight stay. So that's you're going out of your location. Typically, they say you've got to travel at least 50 miles or more, such that you can't just run home. So you travel to a conference, you travel to visit a client, that sort of thing. That's travel. Transportation is in your local area, getting from one place to another, that sort of thing. So that's the difference in the reference within the law as far as when they're referencing those two terminologies. So, local transportation, getting from one place to another. If you work in two different places, regardless of whether you, um, if you're from one to the other, if you have a business and you go to a client and then from that client to a second client, that transportation from the first to the second client is a transportation cost, a deductible cost. Okay. All of those visits to the clients and customers can be local transportation costs. Okay. Um, if it's a business meeting away from your regular workplace, it can be a transportation cost. And to and from a temporary workplace, one that is not someplace that you would normally go, can be. Now, the key thing with a business when you have your own business is if you can establish, and we'll talk a little bit later about this, um, a home office, then any transportation from your home office to any client, okay, any errands or anything like that can be deductible. Now, errands can be deductible, transportation to get supplies for your business, that sort of thing, even if you don't have a home office, okay? If you need to get someplace for your business, that is deductible. What you have to be careful of is commuting. If they can say that it's just your way of getting from your home to your business, that is not deductible because it's not deductible for someone who has just a regular job driving to work. That cost is not deductible. So if you have a business that it doesn't create automatic, you have to have either a home office or you have to be going to a place other than where you normally go to work. Okay? So that if your business is located in one location, you instead of driving to that, you go to a client directly. That's not commuting. That could be um, a transportation cost. However, most of the time they'll say, well, if you went to if you commuted into work, how many miles would that be? And you went this many miles more to see the client, then that will only allow you to count the more, not just the total uh, travel total mileage. So now that we know what which miles are deductible, how do you know the cost? Well, you can keep track of all your actual expenses, how much you spend on the car, how much you spend for repairs and gas and oil and all that kind of stuff. That's quite a burden of keeping track. And so they've given everyone as what's called a standard mileage rate, 65.5 cents for 2023. It allows all you need to do is show that you did the miles and what the purpose was for, be able to give you a reason, okay? and then you can deduct that mileage times 65.5 cents. And you don't have to show how much you spent on gas. You don't have to keep all your receipts. You don't have to, all that kind of stuff, and it makes it a lot easier. Now, for some folks, it will be a higher deduction to keep the actual receipts, and you're allowed to choose the higher of the two. If you know, that would be what you would recommend to your clients, is that they choose the higher. But there's a lot more expense, a lot more that goes into keeping track of actual expenses. All right, and so now it doesn't have to be a huge burden. I mean, you can just have, for instance, if you use a vehicle almost entirely for business, and then you have, say, a credit card for that business, and then you always make sure to use that credit card for anything on that car, that business, that makes it not that difficult to keep track of actual expenses. Generally, if you're driving something that gets poor gas mileage, like for instance a bigger truck, then you probably are spending more than 65.5 cents per mile. Most other vehicles, you're going to be, the 65.5 is actually on the high side as to compared to what you actually spend, even when you consider depreciation. Now, you cannot take the standard mileage rate and take depreciation on the same vehicle. Depreciation is built into the 65.5 cents. If you can only do depreciation on all the bonus and all the things we learned in the last video, okay, for the automobile, only if you take actual expenses. So you take the depreciation and then you do all the other gas and oil and all that stuff. So back to the travel. So we're not talking about transportation. We're going out of town. We're staying overnight. The cost of getting there, your meals while you're there, lodging, okay, while you're there, incidental expenses, like you have to get something dry cleaned while you're there or taken out to be cleaned or something like that, are allowed as expenses, okay? Soon as you have a trip or a place that lasts more than 1 year, now you're talking about changing your tax home, meaning now you're not, that place is not away from home. Your home is moved to wherever you're staying. Okay, but even if you get an assignment for 3 months, okay, that's still business travel. Even though that you stayed there for 3 months, the cost of getting there, the cost of lodging while you're there, meals and all that can be deductible. Now, meals are always 50% less, as we'll see on the next slide, okay? Now, there is a limitation in the law that says you can't be lavish or extravagant. If you travel for multi-purposes, meaning you have a client to visit, but you stop off and see a friend or family or something like that for a couple of days, you have to allocate your cost between the business part and the personal part. And if you go overseas, the limitation is even more so. You have to have, there's more of a consideration. It might be personal than it is if you're flying somewhere in the United States or traveling somewhere in the United States. Now, meals are only deductible 50%, okay? It has to be. Now, if you're not traveling, okay, when you're out of town, you don't have any choice but to eat what is there for available, okay? So at that point, those are all deductible. But you can have meals that are related to your business, even if you're not out of town, not entertainment anymore, but your meal must be directly related or associated with business, meaning you better have documentation of the person, the client, or something that you went to lunch with or went to dinner with or whatever, and everything like that. When you are traveling out of town, again, to make your life easier, if you don't choose to keep all your receipts for restaurants and all that type of things, you can take a $59 per day. Instead of having to show all your receipts, all you have to do is document the purpose of the trip, the days you were there, somehow prove that you were there, maybe a hotel receipt or something, and what client you saw. And then each day you can deduct just $59, assuming that that's what you would spend for meals and all the other things that you would need while you're traveling out of town. And therefore you've reduced the load on how much record keeping you have to take care of. Now, back to a big deal for a lot of businesses. I see a lot of these on the Schedule C, and that is the business use of your home. Okay? The law says that it must be exclusive, regular, and for the taxpayer's trade or business. Can't be a hobby, can't be for rental activity. It has to be a business. And so basically there's got to be a place in your house that you use only for business. Is the law. It does not. You do not have to see clients. They do not have to come to your house for this to qualify. You don't have to necessarily sell things from your home office, but there needs to be no other place that you can go to do some of the activities of your business. It can be just for instance, if you were a sales rep and you were on the road and you did a lot of traveling, okay, but you came home and you used your home office to then follow up or send invoices or whatever it is that you do back in your office, even though you never brought anybody to your office, it wasn't your primary place that you earned your business. If it was still necessary for your business and exclusive to your business, then you can deduct the cost of that home. So how do you do that? Okay, well, there's a form, of course, 8829, and basically most people used, and what usually gets the best response from the IRS is if you figure out the area you use in square footage and then compare it to the whole square footage of your whole house. Okay, if you regular expenses for your business like office supplies, that is still deductible 100%. That's, if you use office supplies in your home office, then that's a direct business expense, and those are 100% deductible. When we say indirect home expenses, okay, we're talking about utilities, taxes, rent, perhaps if you're renting your home, repairs on the home, all that kind of thing. Insurance are based on square footage. So if you spend $1,000 on insurance on your home and you use 10% of it for business, then you get to deduct 10% or $100 of that insurance you pay on your house. Now, they do make some stipulations about how you do this, okay? When you are calculating your deduction for home office, you have to deduct mortgage interest and real estate taxes first. You'll remember that those two are part of our itemized deductions back in chapter 5. All right, so you have to deduct those first. What portion, your percentage that's represented by your home office first, before you deduct any other expenses. Now that's kind of a disadvantage because what you get to deduct the interest and real estate taxes anyway, okay? And so you really would like to save those for last in case you run out of income, because there also is a limitation that says you cannot have a loss from your home office expenses. Meaning, if your business has $10,000 of revenue coming in and you have $2,000 of direct expenses, okay, you have $8,000 of income, you can only deduct up to $8,000 of your home office deductions. And any more than that has to be carried over. Cannot be deducted in the current year. It has to be, you have to wait and to try to deduct it next year if there's enough income in the following year. So as a lot of home businesses are not making a whole lot of money, that means that this could be a very real issue. And so you would like, in case you run out, you would like to run out based on the interest and taxes, because you get to take the rest of it on Schedule A for your itemized deductions. But they don't do that. Okay? First, mortgage interest and real estate taxes, whatever percentage applies to your home office. And then you look at insurance, utilities, all the other things, including, now this is if you own your house, not if you rent it, depreciation. You can actually calculate depreciation on your house for the part of your house that is used in the business. But it becomes a commercial, non-residential building at that point, at least the part that you're used for home office, and is deducted. The depreciation, we use 39 years. Remember, that's the number of years that we use for non-residential, and that's what's happened to your house. You've designated as a commercial, non-residential location, the home office part at least. Okay, so another piece that comes about in with a business has some special rules, and that is what's called a bad debt. Now, the key thing to remember here, people get this, don't understand this a lot when you're working with clients. Only businesses that are using accrual accounting, which is a very small percentage, especially of small businesses with a home office or they're on Schedule C. Most of them are not reporting accounts receivable. So they're not reporting income until they actually receive it. You cannot have a business bad debt unless you have accounts receivable, unless you are an accrual, because you don't account income until you actually receive it. There is nobody that owes you money that you've already counted as income and that you need to take off. Okay? But if you did have accrual accounting, then what you can with a business bad debt is going to be partially worthless, meaning they owe you $5,000, they've paid you $2,000, and they've indicated that they are not going to pay you any further. You could deduct the other $3,000. Again, only if that was something that you were owed based on accrual accounting. Also, business casualty loss, meaning this is a unexpected event. This is different than personal casualties you learned about in Chapter 5 because it happens to your business property. Okay, you receive an ordinary loss. It doesn't have the limits that apply, the 10% of AGI limit, that sort of thing that happens with personal casualty loss. Still has to be unreimbursed, means you still have to submit your losses to insurance to see if it'll pay anything before you know what your actual loss is. So if the fire happens to your business, it's treated a little differently than if a fire or some other casualty happens to your home. Now, when it happens to your home office, that gets a little bit tricky, a little further along than we want to talk about in this class, but and how you might have to split that. But that's the idea, the difference between business casualty loss and a personal casualty loss. Just a reiteration, if it's a hobby, okay, expenses are not allowed. Any income, according to the law, needs to be reported. So even if it's a hobby, you sell a painting, let's say, that you did just for fun, but you decide that, let's see if it'll sell. If you sell it, that's income, okay? But the expenses, the cost of the paint and everything is only deductible if it is a business, if you're in it for profit. So you could end up with hobby income, but no hobby expenses allowed if it can be determined to be a hobby. Okay. Education expenses. If you're a business, again, this is if you're a business, if you pay for classes or anything like that while you're running for your business, if it maintains or improves your skills, it's deductible. Okay, if it meets the express requirements of the law, regulation for a job. So my job as a CPA, I'm required to get 80 hours of continuing professional education every 2 years. That's an education expense that's deductible. Okay, what the law says, and this is a real kind of a mushy area, it's not deductible. Okay, if it is necessary just to meet the minimum education requirements for employment. So, for instance, if you started your business and then to operate that business, you need a bachelor's degree, and so you go ahead and finish your bachelor's degree, and you say, well, the cost of getting this bachelor's degree should be deductible as a business expense. They would say no, because that's just meeting the minimal education requirements for the employment. Okay. And also not deductible is taxpayer if it's for a new trade or business. So if you're in one business and you go to classes for something entirely different, okay, now what constitutes different kind of depends. I mean, I take legal type classes because a lot of this tax law is legal. Okay, I'm not becoming a lawyer. I think it helps me maintain my skills as a CPA doing taxes. And so I would argue that that is not a new trade or business, even though it might be the same class, type of class that a lawyer might take. Okay. So there's some gray area there that you would have to make your argument. And my experience with the IRS is you can make a good argument that way. You usually can make that work. Again, you're usually not talking about a whole lot of money for them to argue about. Okay. Then we have self-employment tax, a big issue when it comes to having your own business. You are subject to self-employment tax on the income from your business. That's covering Social Security and Medicare. Those are things that you pay from withholding if you're an employee of someone else's business. You pay it out of your check. They match that. And so it's covered by both the employer and the employee. When you are self-employed, when you have your own business, you are both the employer and the employee. So you have to calculate self-employment tax on first $160,200 of this income in 2023. That's the limit. And it goes up. That limit changes each year. Medicare is not limited, so that goes on forever. And then there's this additional Medicare if your income is over $250,000 for joint or $200,000 for others. All right, you have to take your self-employment income, multiply it by 0.9235, and then multiply it by the 15.3% you see, okay, to calculate the self-employment tax. We talked about this briefly back in chapter 4, because half of that self-employment tax is deductible for AGI. So it's also a deduction because they know they're going to require you to pay it here, but you do get a business type deduction for half of it. All right, so you calculate your net. Now, where it gets a little tricky and where you're going to have some problems in our homework is when you have income from a regular job with wages, and so you've paid some Social Security and some Medicare through your employer, okay? And then you also have your own business. As long as both together are under the $160,200, you just pay on all of it. But when you go over the 160 between the two, then even though it wasn't over 160 for the self-employment income, because you had other income that was already taxed for this type of tax, you don't have to pay it on all your self-employment tax. Okay, so you need to be able to calculate. So if you make $100,000 from your self-employment, and you make so much from your job, then you can compare, but together they should not. You don't have to pay on anything over $160,200. So you subtract out what you made what you already paid tax on for your employer before you calculate the self-employment tax, or the 160,200, and you multiply by the 0.9235 before you apply the 160,200. Okay, and then the last deduction is kind of the weirdest one, as I put it, because you have to add up all your other income and deductions, because this is a deduction that's based on your income, not on your revenue, but on your income after your other deductions. So it's kind of weird that way. It's 20% of your qualified business income. Basically, you take revenue, subtract all your regular expenses, then you take that number, you multiply it by 20%. So if you lost money, if you have more expenses, then this doesn't apply, okay? Or 20% of your taxable income. So that you have to go through the whole process of calculating everything on your 1040 to see your taxable income too. You can make the comparison. If your income from business is a small percentage of the total income, then that's an important restriction. If your all income comes from business, your self-employment, your business, then it's really, those are going to be basically this pretty close to the same thing. Or it'll just work out pretty much. The limit will be the 20% of the QBI. Okay. This applies to everybody. Basically, it doesn't matter what your business is, doesn't matter what a lot of the things that you put into your business until you reach the thresholds listed on that third paragraph. Okay. Once you get to 364,000, that's pretty high, 182 for everyone else. Okay. Then other restrictions start to come into play, meaning certain businesses don't get to take it, or it phases out if their income is this high. All right. So if your income's under those, it doesn't really matter what business you're in. But as soon as it starts going over that, then lawyers and accountants and consultants and engineers and anybody that's like kind of works in a profession is going to have limitations. It's going to start phasing out. You can make up for that in certain instances if you have a lot of employees that you pay W-2. Okay. If your business is something that has a lot of employees, it's not a profession like I mentioned, but you're manufacturing something and your income is higher than the 364, you could still have the QBI if you have a lot of W-2, because then there's the limit is based on how much you pay out to your employees, or how many assets you have, cost of your assets, so the total cost of those that you have. But those limits only come into play when your income is at these higher levels, your client's income. And then you start have to think, okay, if our income is starting to talk about that, is this business the right type of business? Meaning, is it not a profession? Okay. Is it, and if it isn't, then the next question is, does it have W-2 wages or a lot of assets needed in the business when we still may qualify for this, even though we're over this income threshold?